guys, welcome to my YouTube channel. Today we'll be talking about unit trust and mutual funds. If you're new here, click on the subscribe button and turn on the notifications. If you're returning, make sure you like and share if you find this. So one may ask, why unit trust and mutual funds? I reckon there are many things you can invest in, be it bonds, equities, treasury bills, fixed deposits. But I'm doing this video basically because there are many people who do not have maybe much money to invest in all these things and reap better returns. Now, what are unit trust and mutual funds? Now, throughout this video, I'll be using it interchangeably. They are basically the same thing, or they work on the same principle. The underlying difference is just the legal structure. Now, mutual fund is both a company and an investment, whereas unit trust is just an investment. All right. So we'll zoom into what unit trust and mutual funds is. Now, if you went on your own to, let's say, buy a fixed deposit or a treasury bill, how much interest are you going to get? Or how much do you really know about what you're investing in? So that's where unit trust and mutual funds come in. Now, the role is there's a fund manager who pulls resources from investors and invest on their behalf. So instead of you going and buying a thing on your own, you can invest in a unit trust and mutual fund which buys it on your behalf. So basically, a unit trust or a mutual fund is just a pool of investors who have come together and appointed a fund manager to invest on their behalf. As simple as that. Now, what do they invest in? So depending on the kind of mutual fund, they can either invest in equities, bonds, money markets like fixed deposits, treasury bills, cocoa papers, or maybe some long dated instruments like corporate bonds and many things. So just depending on the kind of unit trust and what they can invest in. Now, I'll talk about the various types of unit trust that we have in Ghana, because that's where the focus will be today. Now, there are many types of mutual funds or unit trust in Ghana. Now, I'll talk about 5 different types. Now, the very first one is what we call money market unit trust. Now, what are money market unit trust? So basically, they invest in short-term dated instruments, that is, with or securities that have maturities of less than 13 months. So, for example, fixed deposits, treasury bills, cocoa papers. Now, it is good if you have a money market fund if you're looking for a short-term investment. Other than going and buying a fixed deposit on your own or buying a treasury bill on your own, you can look at money market mutual funds or unit trust. Now, the second type is what we call the fixed income unit trust or mutual funds. Now, these invest in long-dated instruments or securities like government bonds, like corporate bonds. So that's another type. Now, the third thing or the third type of unit trust or mutual fund is what we call equity unit trust or mutual funds. Now, the equity trust or equity mutual funds invest in securities that are listed on the stock exchange. Now, the fourth one is what we call the balance fund. Now, as the name suggests, balance has a mixture of both the money market, the corporate, and the equities. So basically, if you want to enjoy all the benefits and also the disadvantage of having all of these ones, you can invest in a balance fund. Now, the final one is what we call real estate investment trust. Now, they invest in property and in, let's say, immovable property like, let's say, buildings, lands. Those are also there. So those are the 5 types of unit trust and mutual funds. 1, the money market unit trust. 2, fixed income unit trust. 3, equity unit trust. 4, balance funds. And 5, real estate investment trust. Now, I'll talk about who can invest in a unit trust or a mutual fund. Now, basically, everybody can invest in it, whether you're a short-term investor or a long-term investor, or you are in between, that's you are simply a moderate or a medium-term investor. Now, why? Now, I mentioned that each type of unit trust or mutual fund can invest in certain types of securities. So depending on what you're looking for, then you can look at the unit trust that is for you. So, for example, someone who is looking for a short-term investment can look at the money market unit trust. But if you're looking for, let's say, a long-term unit trust, you can look at, let's say, the equity one, the balance one, or let's say, or even the fixed income ones. So basically everybody can also invest in it. Now, most people who are risk tolerant in the risk scale that I've already discussed in my previous videos can invest in the unit trust. So you need to be a bit of risk tolerant to invest in a unit trust or a mutual fund. So that's basically who can invest in one. Now, how? Now, there are many of them on the market, but you can look at the SEC website. I'll leave the link to the website in the description. So there are many of them. I'll touch on a few when I mention examples of them. Now, you just go there, you speak to them, they will open a form. Usually what you require is just a form that you fill, an ID and a proof of residence. That's either a national map to your house. So that's a very simple process to actually open an account with any of the firms. Now, let me just talk about some few things that you consider when you want to invest in a unit trust or a mutual fund. Now, the very first thing I want to talk about is the interest rate on it. Now, unit trust and mutual funds are not supposed to guarantee you returns. That is, they're not supposed to give you a fixed rate that you'll be earning. So guys, when you want to invest, be careful if you go to any unit trust and they tell you that they're giving X amount. They can project for you based on their current trends. That looking at how you are doing will end up the year around being, say, 15% or 16%. But if they guarantee you a return that, say, okay, at the end of the year you're getting 20% or say 19%, it should be a red flag for you. Now, the second thing about unit trust and mutual funds is you get compound interest. That is, you get interest on a daily basis. That's a really great way to earn more money. Now, how does it work? If, for example, today you have 100 cedis and the following day you get interest of 1 cedi, making 101, your interest is now being calculated on the 101, not the 100 cedis. That's how compound interest works. Meaning you get more money if you invest in the unit trust or mutual funds. Now, the third thing I want to touch about is liquidity and flexibility. Now, if, for example, you invested on your own in, say, a fixed deposit or a treasury bill, it's sometimes a bit difficult if you want to, let's say, top up or you want to redeem a part. But with unit trust and mutual funds, you have that flexibility of having to withdraw part and also top up. So if you're a salaried worker, you can also be doing monthly contributions to it. So it's very easy and very simple. Now, the fourth thing is the requirement or the minimal requirement that you have to get in terms of money. So you don't need so much to invest in, let's say, a unit trust or a mutual fund. With that, for most of them on the market, with as low as 50 cedis, you get to enjoy great returns. So instead of, if you're a student, you don't have to say that, okay, I'm waiting before I earn so much before I can invest. You can start with as low as 50 cedis, which is a great tool to start investing with. Now, that's one of the advantages. Now, the last thing I want to mention is, or last but one really, is that you get someone who is professionally trained to manage your portfolio for you. So instead of you going on your own to buy something, you get someone who has been trained in the field of investment to manage it for you, which is a great tool to have. Now, you don't have to stress about where I'm putting my money in terms of is it a good place or not. All of these things are being handled by a fund manager who has been trained. So it's a good tool to have. And the final thing I want to touch on, which is really key, is diversification. Now, if you invest in a unit trust or a mutual fund, you enjoy the benefits of diversification because most of them invest in different securities. So, for example, if you're in a balanced fund, you can get to enjoy the upside of the equity, the fixed income, and also, let's say, money market. Let's just say you're even in the money market space. You get to enjoy the benefits of being invested in multiple companies. For example, a money market fund will not just invest in company A or company B. Let's say they will invest in Bank A fixed deposit, Bank B fixed deposit, and also, let's say, government treasury bill for a money market fund. So you get to have a diversified portfolio. Now, the final thing is, no matter the amount you have in the unit trust or a mutual fund, you will enjoy the same amount of returns percentage-wise. So if I have 100 cedis and you have 1,000 cedis, we both get the same return in terms of percentage. But obviously, the nominal amount will be different because I have more money, so I'll usually get more return if I have more than you. Now, having spoken about the beautiful things or the upside about unit trust or a mutual fund, I decided to touch on the downside that I know of. And basically, it has to do with the fluctuating returns. in that you don't really know how much you make at the end of the period. So for example, you can't say that at the end of the period you get say 16% or 17%, even though they can tell you that based on our trends we will likely end the year around 16%. That particular rate is not fixed, so which is not much of a downside, but I said to just point out to you guys so that you know. So remember that unit trust and mutual funds are not supposed to guarantee you returns. Now, having said that, I think we can focus on other things. So my next videos, I'll talk about fixed deposit, I'll talk about treasury bills, and I'll talk about equity. So if you enjoyed this video, don't forget to subscribe and leave a comment below. Thank you.